was a sight from my soul.
We had a question recently, which was, why will life insurance companies survive the next recession? Which is a great question. And to answer it, really we will start by looking at past recessions and how they survived those, or when they survived them, what their dividend rates were. They actually continued to pay the guaranteed rate and dividends. But then, really, where are their assets positioned? How are they equipped to be able to survive a market downturn or economic downturn? And we're going to go through that in detail. So the first thing I want to understand is when I look at a life insurance company, is where do they position their assets? And you can actually find this, and any agent can provide it to you, through what is called a vital signs report. And this will provide a full breakdown on an insurance company's assets, liabilities, income. You can look at past results as well, so you can go several years back. You can see how much life insurance they have in force. You can see how many policies lapse. It gives a ton of insight as to an insurance company's actual books, which does show you their strength. You actually see all of their financial ratings from the different rating carriers on this as well. So this is extremely helpful to look at their present strength and where their money is actually positioned. What I also look at, though, is when you look at just a life insurance company in general, you can look at their dividend history. And in particular, when there have been downturns, like this, for example, and all the downturns before 2008, what did insurance companies do? Or the question we get all the time is, how on earth have these life insurance companies continued to pay dividends? Back then it was around 7 to 8%, depending on the company. How do they not only pay a dividend in 2008, 2009, but continuously pay continuous dividends all the way through and maintain a guaranteed rate of 4%? And really what it has to do with is, where is the insurance company's assets positioned? So if you go back to the 1980s, and this is really interesting, you will see that an insurance company, their assets were heavily positioned in bonds. Right? You could see around 80% of a company's portfolio invested in bonds. Life was easy back then for them. What they would do is just buy bonds. These could also be 20 or 30-year bonds. Remember, in the 80s, what were very high? Interest rates. So they could buy a bond at, call it 16%, if it's 25 to 30 years, and just hold on to the thing. Now, we are in 2020 now, so that window is all but closed. There might be a couple bonds left, but it's just about gone. And they've been expiring. What's been happening, if the bond portfolio was 80% back then, you'll see today, depending on the company, the bond allocation is 50 to 55% and decreasing. Meaning, as these bonds come up for renewal, when they expire, companies are not renewing them at the same rate. And a big reason why is because they can't. A bond might not even keep up with the company's guaranteed rate, let alone help them continue to pay a competitive dividend. So where are they positioning their money? Well, I can look at a vital signs report. One alternative as well, or two alternatives, you'll see insurance companies position their funds. Let's clear out some space here. Perfect. One is high-end commercial real estate. And when I say high-end commercial real estate, I'll put my little house here for you, Jada, this is very rarely buy and hold. Meaning, when they buy a piece of property, any kind of real estate, it's almost always going to be income producing, cash flow producing. This way, if real estate values crash, they don't have to worry about it as much in that respect, because if they own a skyscraper in a metro city area or a multifamily unit, if people are there, they have to continue to pay their lease. Pretty straightforward. So the income producing real estate is very attractive. And they go to metro city areas, they acquire real estate that you and I as an individual consumer cannot. You don't have the billions of dollars in capital to do so. Another area, and this one is really interesting, other businesses, which you will see insurance companies invest in partially or outright purchase. So a couple examples. In the past, of the major mutual companies, Mass Mutual is a large insurance company. What's interesting, for the longest time, they had owned Oppenheimer Investments. They don't anymore, but that was a company they had owned. More recent, in 2016, they bought a division of MetLife. And there's other businesses, and all companies do this as well. My point being, they're looking for income producing assets, meaning what's going to pay me a high return that is not invested in the stock market. That's what I'm interested in, because I have to not only keep the guarantee up, but I have to continue to pay a competitive dividend, which will attract consumers to my product. That's if I'm the insurance company, whether I'm Mass, Guardian, New York Life, whoever. So what I want to look at as the consumer is some dividend history. Here's one of the top carriers. We've got Guardian, their 2019 rate, 5.85. We don't have their 2020 on this sheet. I'll write it over here. It'll be 5.65. Point being, when recessions have occurred, what's happened here? We do not see dividends just stop. When there's a market tank, you don't see a life insurance tank. When there's a market boom, you don't see a life insurance boom. And I'm specifically talking about not life insurance sales, but the rates paid, the guaranteed rate and dividends. They're declared annually and paid consistently year over year. You will see them tend to move up and down with the interest rate environment though, and that's where you see the gradual move over time. Some further validation of that is when you look at the 80s here, what were CD or mortgage rates? Double digits. What do you see here with dividend rates? Double digits. If you look at another carrier, we've got Mass Mutual, dating back to 78. Let's look at the same trend from 1984. We've got double-digit dividend rates through 91. You want to look to the right for more recent years? Almost missed it. 2008, 7.9. 2009, 7.45, came down a little bit. They were invested in other businesses, maintained a competitive dividend rate there. In 2020, it'll actually be 6.2. So this is great. It helps forecast or helps see what companies have actually done. Now that vital signs report, let's see exactly what that is. So here's three of your big four, Mass, Guardian, and New York Life. We talked about the ratings first. So here is your AM Best, Standard & Poor's, Moody's, Fitch, Weiss, all that stuff is good. The Comdex ranking though, and this is a little bit old, this vital signs. Guardian's actually at a 99 now. Mass is still at a 98. New York Life's at 100. 100 being the highest you can get. You'll see the top four. We've seen this to be fairly consistent. They've always ranged between a 98 and 100. So when you look at the AM Best, all A++. Northwestern will be the same thing. Top tier, and this really represents the financial strength of the company. So you see financial strength, 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 strength. Weiss is a safety rating. How safe are they based off of their assets? You see all within the top three classes. And as you scroll down here, right, you see exactly where their money's positioned, how big their how big the company is in terms of admitted assets and income coming in. And what we're going to look at here actually zip down to the graph. There we go. Right, so this just gives you an overview here of MassMutual. And this goes from 2013 to 2017, so we need the more recent ones, but that's okay. You get a good sense of their investment yields, where they're positioning their money, where has it fallen? Close to 5%. And that gives me the averages right there. This information is available with any insurance company, which is nice. See a nice breakdown of their asset distribution. There's Mass closer to that 55% range now. Right, if we look at Guardian, there you go. You're going to see a very similar trend with all of these carriers. So there's their investment yields. Asset distribution as of 2017. That we do need to look at the updated one. And you see New York Life went down a little too fast there. All similar. I know this is a lot of detail in this particular video. Main point is if and when a recession occurs again, how will the company survive it? Well, they always have, because their assets are positioned in safe areas. It's not linked or invested in the market where if there's a crash, everyone's going to lose their money. No, a life insurance company has to have their cash in safe assets. Remember, their first and foremost obligation as a life insurance company is to do what? Pay out life insurance claims. You'll actually see state laws for life insurance carriers often that enforce how much cash, liquid cash reserves they have to have on their books. For example, for every dollar of insurance in force, you've got to have that dollar plus another 3 cents just in excess reserves to be able to satisfy claims. That prevents you or me from starting a life insurance company. So their money is positioned first for life insurance, but the safety, liquidity, and consistency as far as the cash value build up, no risk, has always been there. Know this one was detailed. Hopefully it was helpful.